Maytab here for Finance Operators. Today we have Dan Glazer on from Postscript. He's just walking us through some of the cool things you can do with Fondue, and we're going to cover a lot of exciting topics. We brought Sean in from Ridge as well to help us out, so we're going to cover what's going on macro-wise with e-commerce. Is it a good time to be in e-commerce? Is it a bad time? How much should you pay yourself? When should you pay yourself? What should you watch out for? And then we're going to dive into some of the ways that Postscript and / Fondue can help you save money, juice your margins, etc. We'll have a lot of fun, so stick around and get ready to learn.
When Beller suggested I do this, he was also thinking like with finance operators. My background before I was at Postscript, I started the trade finance product at Flexport. So we do logistics financing, basically would fund your shipment, the goods, customs, everything. Basically help smooth out the cash conversion.
When were you there, Dan?
Merchants. I was there from 2017 to 2020.
Do you remember who was the lady running it in 2019, or like the head of credit or something? She used to work at White Box.
I know Barry well. Yeah, you know.
Barry,
no,
not
right?
Barry. Barry went to settle. Who was there before him? Or after? Sorry, after some lady came in.
Kiana, maybe.
I don't remember. She used to work at White Box, like the lender. I can't remember.
That may have been after my time.
Okay.
But Dan, you left Flexport in 2020. You left right before it got interesting, or what was the thought process there?
I got laid off as part of the big COVID rip. So I think it's kind of interesting. Flexport thought, right, like most companies did, that we'd enter a massive recession and all of the non-core business lines should be trimmed.
They pulled my credit, Dan. They pulled us 2019.
Yeah.
It was Claire.
The exact opposite happened.
Her name was Claire. Do you remember Claire?
That might have been on our core finance team potentially. So we had the core team that would just do freight billings, but then the Flexport Capital group would have been my team where we were actually financing the goods.
Okay.
And the goods, the customs duties, the freight costs. And so instead of just giving like net 15 or something, we would do an installment plan so that we'd pay your suppliers on your behalf, and then you'd pay us over time, right? 90-day cycle, 120-day cycle, really designed to bridge the gap between like traditional asset-based lending and when you actually needed to outlay cash for paying suppliers.
Well, Dan, is that product still around?
The product is still around, yeah.
Interesting.
They changed it a lot, though.
Yeah, I would love to look.
I think it's gone through some big evolutions for sure.
Yeah, this is not a plug for alternative financing, but it isn't. Let's talk about the economics of that, man. This is the finance operators.
Yeah.
Everyone hates Shopify lending and Amazon lending and any sort of merchant cash advance because the money is so expensive. Maytab, off the rip, how expensive is that money?
If you actually calculate the effective interest rate, it's like 30+%. It's like 30 to 40% with Shopify Capital. It's pretty insane.
And they put themselves at the very, very, very top of the stack where they take the money out every day from your Shopify account. So maybe you want to buy new inventory, can't. You got to pay back your loan first. So Dan,
totally.
How are you guys underwriting that? Like, is that an actual profitable program to actually lend out? Like, how does it work?
I mean, at the time I was there, it was quite profitable. We the way Shopify is underwriting is they're technically unsecured, but they have access to your cash. So it doesn't really matter that there's no assets backing it. They just cut the line and take the money out, as you said, which is pretty unfair to merchants. And then they charge a credit card rate. What we were doing was trying to sit somewhere in between a bank loan and the merchant cash advances. So we were averaging, call it 12% APY, right? We were second in line technically to the bank. But the asset, what we had to underwrite against was two things. We knew your business well. Right. We knew if you were routinely buying goods, paying your suppliers, shipping on a regular basis, if you were growing, et cetera. So we would look at all those metrics. And then we also had the goods in transit. Right. So we weren't fully secured, but there's this interesting thing with freight forwarders. That's an old school maritime law from like the 1600s that basically says if you're a vessel owner and you've got goods on your boat and someone owes you money for those goods, you can hold them and seize them at any time until they pay you. And that kind of goes up the line, right? So first it's the vessel owner, then it's the freight forwarder, then it's any other brokers that are in between there. And so, even if the bank has first position on your goods, right? If you've got a bunch of wallets sitting on a ship and you owe your logistics company money, they can be like, hey, we're not delivering until you pay us. So we had a little bit of leverage in the instances of people wanting to push out payment or try to default. And then obviously there's an incentive to anyone who does want to get their loan paid back. They want to get those goods so they can sell them to try to recoup some of those costs. So we sat in a really advantageous position, which allowed us to take a little bit more risk than a traditional lender. But we did have to charge a premium to a bank as we don't have the cost of capital that they had, for example.
Dude,
Drip Capital offers something similar.
Yeah, Drip ended up doing something very similar as well.
Their business is very weird though. They were I don't know what happened to them. They kind of like disappeared for a bit. Now they're coming back. I don't know. Yeah.
Yeah, it was interesting. I kind of thought there'd be more of a renaissance of these alternative finance companies as interest rates have gone up. I would say that the hardest struggle for us was that money when I was at Flexport with this product was money was so cheap that like people didn't and so available in 2019 and early 2020, even before 2021, that people just didn't need it, right? They had so much capital, interest rates were already near zero that people didn't need as much alternative financing outside of like the really small business segment. As interest rates went up, we always thought, oh, that would be the golden age for alternative finance, right? Where there's actually enough of a spread and it gets interesting and bank loans go up. I don't think we've seen that as much as I would have expected. And I think that's where I thought, someone like Drip would shine, but I haven't seen that.
Look, Wayflyer still seem to be doing well, but lending is the world's worst business because
it's kind of interesting, by the way. Like,
well, it's either the world's worst business or the world's best business, depending on how you.
Clearco was like the OG and they got wiped out, but Wayflyer somehow survived. And Wayflyer, I remember they launched, I was just like, oh, this is just a clone of Clearco, of Clearbank, right?
Yeah.
And they were the first ones by like 3 or 4 years. They'd been in operation for a long time, like 2016 or something. And then Wayflyer came out in 2018, 2019.
Yeah. Yeah, we didn't see Wayflyer too much back in the day, but we definitely saw a lot of folks, they looked at us as a alternative to Clear. And we would allow you to stack it, right? We were solving a very specific niche at that time. It was like, we pay your suppliers. So the only use of funds was directly paying suppliers. So that was another thing, right? People couldn't take the money and buy a boat. They couldn't take the money and throw it in Meta. It was like, we wired funds directly to your suppliers. And we knew exactly what those invoices were, that they weren't fraudulent, all that stuff, because we were actually providing the logistics. I think for other folks, they run into a lot of challenges with, misuse of funds or even not, nefarious uses of funds, but just people who don't manage their business well, right? And take out a loan to fund something that is crazy.
Right. So
we bought a business from a lady who, this is really funny, I have to tell you guys. She took out a Shopify loan and she bought herself a house because she had gone bankrupt before, so she didn't qualify for normal credit. So she took out a loan from Shopify and bought herself a house.
We when we would underwrite, we'd see some pretty funny stories where, I won't share the names, but think of like the early e-commerce companies blowing up in like 2018, early 2019, we'd underwrite some of these founders and they'd have personal guarantees on these loans. And we'd be like, well, what'd you use the funds for? And we'd be digging in and they'd be like, oh, well, I built a gym on my house. I installed a pool. I got a second home.
That actually goes to the first topic of the day. Thank you for the background. We have Dan runs Fondue, works at Postscript. We're going to talk through all of that. But Meetup, we're going to talk about the very first thing is, as a founder, how do you pay yourself? And how often do you pay yourself? How much money do you actually take out of this business? So, dude, Meetup, start with you, dude. How much money are you making?
Probably too much for how smart I am. I can barely read. Every time, no one's noticed yet, but whenever I'm holding my phone, it's actually upside down. They're like, what are you doing? I'm like, just, reading book. No syllables. Yeah, I'd say, maybe, is it helpful if we maybe start by brand size, growth, et cetera, and then just some of the some of the traps people run into?
Yeah, well, it seems like the biggest trap is taking out a loan to buy a pool, but we'll talk about that.
That's a bad idea. And then I do feel like on kind of the lower end, when people are just starting out, they assume that trajectory of their business is going to continue. Like, let's say they launched with a product, it did fairly well. They just assume it's going to keep compounding. And sometimes that's the case, but usually it's not the case. And they're paying themselves too much along the way and living a little bit too la vida loca. Like I'd say until your company is doing well into 8 figures, you should not be paying yourself too much. Like really just the minimum that you can, and try to keep your costs as low as possible. Because I think what we end up seeing a lot of specifically is a founder will have gone kind of wild with their personal spend. Now they have this crazy lifestyle to support, and the company needs to keep paying them a certain amount of cash. Because of that, to put the company in a bad position where they had to make a bunch of bad decisions that were not good for the company.
I think one way to think about this is, I posted this on Twitter before. People hate it, but like info boys and like drop shippers, like, if they do $5 million in revenue, like they could probably clear $1 million, right? If you're in info products, you're selling courses, it's way more than that. If you're in hard goods, e-commerce, if you have to use Flexport to move shipments and you have to run meta ads, like if you're in the real world of e-commerce, you're probably only going to pull in 1% of top line revenue, right? As like actual founder salary. Because you think about, you work really hard to make your business have OPEX below 10%. I think my people costs last 12 months were like 9% of revenue or whatever. That includes me, all executives, whatever. And like, so taking it from 9 to 10% just to give yourself that 1% of money is like, that's a ton of money. You know what I mean? And I think that's like a good gauge, is you should be probably pulling out like 1% of top line. But if you think about that, it means you have a $50 million a year business and you're making 500 grand a year, right? Like it's not all that what it's cracked up to be.
The big problem is, like, I think you've gone over this before, the scare you guys had where you had a huge tax bill due. You should walk through that.
Yeah. I mean, I wish I would have known about Flexport Capital. I wish I was using Fondue back then. But as your business grows, if you don't have outside funding, like you sell physical goods. This year I sold 10. My business is growing. Next year I have to sell 15. I now have to buy 15 physical goods, right? But I have to do that with the money generated from selling 10 physical goods. So I have to have margin and cash and everything, left over to actually make that purchase. And at the same time, I want to pay myself. And at the same time, the government wants to get paid, because the government's like, no, you sold 10 physical goods. You have 3 physical goods of profit, right? I'm like, so you have to give them half of that. So now I have 1.5 physical goods left, and I have to go out there and actually make that purchase of 15. Now you have timing working with you. You have supplier terms working with you. All this stuff comes together. But dude, in 2018, we had to like not grow for a year because we had this very difficult choice. Do I buy more inventory or do I pay the government? And, the government has a monopoly on violence. They will send you to prison if you don't pay them. So, they won. They beat me.
And they have unlimited funds, so you'll always lose. It's great. And I did the same thing with a guitar retailer that I had, where we bought a bunch of inventory. Things were going well. And then I learned that the government treats inventory as cash, more or less, and they tax you on it. I was like, oh my God, how do I come up with the cash to pay this? So that was not fun. You have to factor that all in, especially if you're growing.
Yeah. And the faster you grow, the more fuel you need just to fund the working capital. And so it's a kind of an endless cycle where the best companies get hit the hardest with all the problems. And a lot of people think, oh, you're getting this big loan, it's a big payout. But, unless you're in the seats, you don't realize, no, that's just purely operating, keeping the business afloat so that we can continue growing, not actually, anything fun, really.
One of the best ways to fix that is with better margins, especially around stuff like CAC. So that's where you can use something like Fondue. We've tested it a bunch before. I like it just because it's an easy way to juice margins. Do you want to maybe just quickly walk through and explain to the audience what the product is?
Yeah. So Fondue helps e-commerce merchants offer a cashback program, right? Think of cashback as, rebates, right? It's similar to the old school Sears catalog, right? Sometimes you could take in a coupon and get something right at the cash register, right, with your order. Sometimes you had to buy the thing, send in the little UPC to get your $50 back. But that little bit of effort that they'd make you do was usually worth a much higher reward. And so Fondue basically allows you to offer a cashback program to your customers as any store on Shopify. What we recommend is that, if you're offering a discount in your pop-up today, if your standard, say, welcome series is 10%, what you'll find is that by increasing that offer to a 20% cashback or slightly higher store credit, which is where the real magic comes in, that what we often see is your signups on, for all your list growth grows. You see more emails, more SMS collected, simply because that's a bigger number. But then the really interesting thing about the dynamics of the program is it's all about customer choice. right? So consumers then, as they're going through and claiming their cash back, they get to choose. Do I want a MasterCard that is fully funded, that leads to that I can spend wherever I want, that I get as soon as the return window closes? Or do I want another, $30 to buy another wallet, right? Or send it to a friend and have another future purchase. So consumers get to choose the incentive that they want. Now, the really interesting thing is a lot of consumers choose not to redeem at all. Right. And we think our theory on that is Shopify consumers aren't that price conscious, right? If you were like the most price conscious consumer, you're buying a knockoff wallet on Amazon.
Temu or
right?
Amazon, yeah.
You're going to Temu, you're going somewhere else. If you're shopping on Shopify, you want the brand, you want the experience. You're probably a busy professional. Sometimes, even though it's about 3 clicks to redeem your cash back, it gets lost in your email, you forget, it's not worth your time, right? And so a lot of folks don't redeem. And that's where we think of this as a choice program, right? You can choose to get the max amount of cash back. You can choose to get the max amount of store credit, or you can get your product, be happy with it, and go on living your life.
Of course, everyone's favorite example of this is Starbucks, right?
Yeah, exactly.
Yeah.
Well, so let's talk about redemption rates. It's so interesting. You guys have seen hundreds of thousands of transactions across hundreds of stores, right?
Yeah.
And
probably close to millions at this point. Yeah.
Yeah. Look at that. Millions, dude. Billions of transactions.
Yeah. Trillions of transactions.
Yeah. So we were talking to Dan before this, and I'm like, look, it's kind of like an expected value game, right? Where like you could keep raising the cash back you're offering to these people just because a certain percentages drop off forever. So, and I was trying to get like the alpha. I'm like, look, do certain does home goods redeeming more than shoes? But you said it's pretty boring and pretty standard. So maybe walk through who redeems.
It's pretty safe. We don't have a ton of data on the actual consumers themselves. So I can't tell you like demographics on that, but definitely higher AOV products, as you'd expect, right? If you're offering 20% cash back on a $100 product versus 20% cash back on a $500 product, it's going to be more attractive to take the time to go get your rebate. So we see a higher volume claimed on higher AOV, more premium products. But the math still typically works out where it's, if the average is, 50% go unredeemed, it maybe bumps up to 55, right? We see a pretty consistent range where 45 to 55% of consumers never redeem their cash back for store credit or cash back. Then the split between store credit and cash back is usually 20-30 in either direction. And that kind of depends on the brand, whether it's a repeat purchase, whether it's like I said, a high AOV product. But one thing that surprised me personally as we were getting to know the business was how many consumers choose store credit, right? So that shows us, right? They signed up for your email and SMS program. They got this offer. They were already really interested in the brand. And just from the way that y'all put yourself out there in marketing, they knew they wanted to become a long-term customer even before they made that first purchase, which I think is really kind of fascinating to dig into.
Right. So half of people never take advantage of the program. So you have an opt-in on your website. Right now we do 10% off. We're in a test versus Fondue. It's a head-to-head test. And we can offer double the cash back rate, right? And we can have a kicker for store credit because half people are never going to redeem it. And then the half that do, half of those people, so a quarter of all people are choosing store credit and a quarter are choosing the actual cash back. And you can run that program and you just head-to-head test versus discounts, and it's still probably cost accretive because we're not testing versus nothing. We're testing versus them already getting 10% off. Is that all correct, Dan?
Exactly correct, right? And there's two real big benefits for the merchant then, right? First is margins. And I should say there's 3 benefits. The first one is margins, right? That's what we really harp on. If you're giving 10% off to everyone indiscriminately, right? Just because they gave you their phone number and it's automatically added to their cart, they don't have to do any work. That's a 10% hit to your AOV. If only 50% or really 30% of people are redeeming this actual cash back as cash, that means you're actually looking at closer to a 3 to 4% hit on your overall margins, on your overall AOV, right? Which then flows directly into margins. So not only do you get higher margins, but then you also get to collect the cash up front, which is the second benefit. So instead of those every order coming in 10% lower. The way Fondue works is customers pay a full price order, then they redeem their cash back. And it's when they redeem their cash back that we would bill the merchant to go fund that program. So you get a benefit of a negative cash conversion cycle there, which is nice. You get to sell the goods before you pay anything.
I didn't even think of that. That's awesome.
Yeah. Well, and that's one of the areas where we, in addition to the margins, obviously, where we thought this was going to be a big help to merchants with tariffs. And the merchants that have actually seen their tariffs go through have reported back it has been helpful, right? Because so many businesses are fueled on, first-time customers, and those that were unexpectedly finding themselves with a, $50,000, $100,000 tariff bill needed to scrounge cash together from anywhere. So the fact that they could increase their AOV and get paid on that upfront right away before needing to pay us for any marketing costs for the program was a big help in that critical time period when that stuff was announced unexpectedly. So that's the two. And then for marketers, the reason marketers love it, and that's what's really interesting about this product is we actually typically sell to marketers. And part of that is because Postscript has a relationship with the retention marketing team or the CMO at the company. And one of their core KPIs is always how fast is my email list growing? How fast is my SMS list growing? Simply throwing a bigger number and a better offer in your pop-up, no surprise, meaningful bump to how many people are giving you their phone number and email. So that's our in, but then, secretly it's the finance teams that really love us.
Well, Dan, dude, you didn't say what I thought would be the biggest benefit is that by giving people store credit, you're just upping retention rates. Like you should be getting second purchases at a way higher rate, right?
You were saying the split among people going for store credit versus cash is roughly half?
Yeah.
Interesting.
Yeah, roughly half of the half that do redeem choose a store credit. Kind of, there's a little bit wider spread. I think some businesses are as low as 20% Visa card up to 30%, and so the store credit would be the opposite way. And then what's nice in store credit, right, is you still get the full price first order, and it's only on the second order do they get that discount or do they get that benefit. And by then they're a very happy customer, right? If they're coming back and they're spending that amount, that is like the healthiest CAC we think that you can get, because now you haven't just bought a one-time customer, you've bought a pattern where someone is now already in the habit of buying your product multiple times. And we're doing some actually retention studies. It's probably an area of the business that we need to look into. It's great to hear your feedback that excites you, Sean. It's something that I think we need to take back and really dive into our data and see, okay, exactly what is the impact on retention? Because it's an area that I think we undersell.
Dude, totally. I mean, if you that's the whole value, right? I think the only people who like the negative cash conversion cycle are super nerds like me, Tab. He's over here being like, yeah, that's awesome. No. If you're telling me customers are going to come back and you just show me the cohorts that they're getting stronger over time, that is a more interesting thing. But
yeah, that's great feedback.
Do you guys know Kevin Hellstrom, like the merchandising guy? You know him, Sean?
Yeah,
you know him, Dan?
Twitter.
Yeah. He has a bunch of cool books that are totally worth reading. Shout out to Kevin Hellstrom. Great blog, really old blog that's hard to navigate, but there's a lot of gold in it. But he mentioned like once you get someone to purchase more than once, twice, it really does build the habit. And you typically do see that retention rate go way up. So that's super interesting. It'd be cool to compare like the lifetime value of a customer who bought during this promotion versus one who does not buy during this promotion.
Yeah, we've done that, and we've seen that that's higher. I can't give you the stats off the top of my head, but we've done the lightweight LTV analysis, but I think that's an area we can go a lot deeper. Sorry, I didn't mean to cut you off, Sean.
No, I was going to change the topic. I'm going to say this is finance operators, Dan. So we want to talk about Postscript buying Fondue because this is a company you guys purchased. So what are the details?
Yeah, why did you do it?
Why did we do it? I think that the first. I would say we did it for three reasons. First, that the headline was we saw the metrics that they were delivering to merchants and we were kind of blown away, right? Like the fact that they were driving more list growth. We saw them showing up in our customers and we saw customers' lists growing faster. And we were like, what is going on here? Where is this alpha coming from? And that was, I think, really where Fondue first got on the radar. And then as we got into the economics of the program and realized how much value that was delivering to customers, and that's what we're all about at Postscript, right? Is how do we do things differently than all the other retention players in the market and find ways to give our customers alpha, whether it's directly through their SMS program or through other ways that aren't being addressed in the market. So we like that. And then I think the other piece, just to be transparent, is SMS is a very low margin business, right? I know everyone likes to harp on how big the SMS bills get and all that stuff, but we're a middleman that's providing a ton of value in our service and technology, but ultimately AT&T and Verizon take the biggest chunk when you send a text message, right? And so we're not a typical SaaS provider who's operating on really, really fat margins. We actually run a very lean business. We empathize a lot with you all. Our gross margins are sometimes lower, actually, than most of the companies we serve in certain instances. So Fondue was a way for us to enhance our product portfolio with a slightly higher margin product, right? Which was great for, obviously our own business, great for our customers. So it was a real win-win. And it was a small enough team where we were, Postscript's not a huge company. We were able to acquire them. I'm not privy and wouldn't be able to share the terms, but we were able to acquire them at a time where it was a really good learning exercise for us, right? We obviously have big ambitions to take over the world and be the absolute, number one SMS provider and help our clients make the most money from SMS possible. To do that, we need to learn certain things as a company, like how to acquire and integrate a team and a brand into our portfolio. And so we were also excited just to get that experience at the stage that we were at. And I can tell you, it's been a ton of learning.
Cool. And then what else have you guys looked at acquiring or acquired?
We have not acquired anything else. I think we're, right now I would say that Postscript is primarily focused on just continuing to provide the absolute best SMS platform. We're not in a particularly acquisitive mood, but I think always opportunistic. I think the things that we would look at are, orthogonal to the messaging space, right? If you're using conversations and messaging to deliver alpha to brands, that's the kind of thing that we're interested in. And that could look at...
So that's who should reach out to you guys?
That's who should reach out. Yeah, whether it's for partnership or anything beyond that. I mean, that's the thing that we talk about and obsess about every single day is how do we make sure that messages and conversations on Postscript perform better than Klaviyo and Attentive? And, we've been delivering that, but it's a very cat and mouse game, right? As soon as we release some innovation, they're 6 months behind. And so we've always got to be thinking about the next thing. And,
I think one of those competitors that you mentioned did something very stupid and they had a little thing where they kept holding lists hostage. So yeah, I know a lot of people, including us, just won't use them outright. I think they may have changed their behavior, but I don't know. So if you are looking at a new provider, make sure they will not hold your list hostage when you move. Just double check that before you make a post in ECF or make a post on Twitter or something and just ask, verify. Postscript does not do that. I can verify that. But some competitors are very bad. Just be careful. So
Dan, and if you guys are looking at buying more stuff, I highly recommend checking out this little wallet company I know about. So maybe you guys, maybe you guys could buy us.
I
Sean's offering 30-year financing, 0% down.
Well, cool guys. All right, so we talked about let's go back to how much money we should all make.
That's true.
So, I mean, I give you guys my rule where it's like 1% of top line revenue is like, I think a good rule of thumb, but like, maybe you can get more in the early days, but it doesn't scale very well. If I told you, hey, look, you're gonna have a $5 million a year Shopify store and you're gonna make 50 grand a year, that might dissuade you. But like, I don't think we started making serious money at Rage until we got above $75 million a year. It's just like, it's just really hard to make the economics work if you're bootstrapped, right? But you could always do what Dan talked about. You could get a loan, you could pay yourself a bunch of money, you could personally guarantee it. And I mean, that does not sound like a fun life to me. But do you guys have any rules for that?
I think the biggest thing to focus on is how well you can actually convert net profit to distributable cash. Like we have that ring company and it's cool because it's all pre-orders basically, like made to order. There's very little inventory. Like we're only holding some raw materials that are fairly inexpensive, and our expensive raw materials like gold, we literally order those from the supplier, then we build the product, and then we ship it. And there's a wait time for the customer. Now, is that a smart thing to do? Are we hurting ourselves? I think we're probably hurting ourselves a little bit. So we're going to monkey around with a few things, but it is cool from the perspective of like, oh, you can actually distribute a weird amount of cash because you don't need the working capital, if that makes sense. Then I guess you could always, depending on how aggressive you are with that, and obviously like you need the right lender for this, you probably have to be at like 3 to 5 million. Nowadays, probably closer to 5 million in EBITDA, not top line, but like EBITDA, to go out and do a dividend recapitalization or something. And that's just when you basically get a mortgage on your company and use that to pay yourself. The cool thing is obviously interest payments are tax deductible. So the actual EIR is a little bit lower than it looks. But I like it because that just forces discipline on the company. I think Sean's like unusually disciplined as someone who runs a company. I'm sure you've seen this too, Sean, where like you're looking at a company and they just get kind of sloppy about costs, right? But you guys have been very, very disciplined about that. And I mean, you still sign off on every check, right?
I personally do all of our AP, so sometimes I'm late to pay Postscript. I'm like, all right, guys, we're gonna slow this down a little bit.
I was gonna say, no, I mean, on the topic, I think the first thing that I think about when you think about, as an e-com operator, what should you pay yourself? I think the very first question you need to answer first is what kind of business are you building, right? I think what surprised me, I haven't been an e-com operator, but was able to underwrite hundreds of businesses while I was at Flexport for the capital business. And, we would see businesses up to 25, 30 mil where the founders weren't taking a dime out yet, but they were growing insanely fast. And I mean, any capital that they could get their hands on was funneled into growth, more product, more meta, right? And so that's a pretty big business to not be taking a dime out. Obviously, you must have funding your lifestyle through other means. But then we would see folks like you said who were at 5 million, taking $1 million out a year because they had a high margin product and they didn't really care about getting to 6 or 7 million in GMV. And so I think that's the first thing. And I think that the most disappointing ends to businesses we saw were ones where the founder never answered that question, right? Where they'd waver between the two. They'd have some years where they'd take a lot of money out because it was a good year and they felt good, but then they try to get back to growth mode, and you really can't do both. So I think as a operator, the first thing you really need to do is decide, like, what are you building? Are you trying to build the next Ridge, or are you going to build a lifestyle business? And then from there, I think, the 1% rule is great. You can definitely go higher if you're not trying to double every year. But if you actually are trying to build the next Ridge, I think not taking money out till 50, 75 is actually the safest way to play it if you can handle it on the lifestyle.
Yeah, and I think this is where, like, you brought up debt being a good tool. Let's talk about, like, back in your lending days. I made the comment that lending is like the worst business. Yeah, it can be a great business. Here's why it's a bad business. You have an undifferentiated product. Like, money is the definition of fungible. If I get money from you, like somebody gives me money, I don't really care who it is. Like, your money doesn't smell any better. And so, like, people then compete by being the most open to lending, right? You either need very cheap access to capital, like a bank, or you have really low standards, so you get people who can't qualify for other amounts of money. And the reason why lending is so bad, it's actually a very low margin business. And if one deal blows up, it's a total zero, right? And that takes out the gains of 50 other brands or whatever. So,
and if you're lending to smaller companies, it's really hard to justify the litigation, right? Like, are you going to spend $1 million to maybe claw back 50 grand? Like, no, probably not.
Yeah. Well, the way that I can't speak for Shopify Capital in particular, but a lot of the MCAs and businesses like that operate, though, is they're just originating, right? And that's an interesting, pretty good business, right? Because you don't hold any of the risk for more than sometimes a couple days, right? And you get it off your books, so your spread's a lot smaller. But they've convinced private equity and Wall Street to take on that risk.
Yeah, like WebBank, I think, is the big partner that Shopify works with. I think WebBank actually works with a bunch because my wife actually works in credit, or she used to work in credit at SVB. And when she was looking at getting a new job because they went bankrupt, that was one of the companies she was looking at working for, like underwriting their portfolio or something. I can't forget what it was. Like the whole chunk of a specific like lender that they were buying loans from.
Well, I think that's interesting for the audience to learn about. So let's go behind the curtain. So let's say I click, oh yeah, I want that Amazon money. I want the Amazon loan, right? Explain the pipes and background that actually ends up happening.
I'll say I can't speak for Amazon in particular, but here's how a lot of them work, right? The platforms themselves often have their own underwriting model, their secret sauce, if you will. They have some edge, usually in customer acquisition, but sometimes the not great ones don't, right? Shopify has a captive audience, so they can spend less than Chase would marketing to you to earn your business. So that's where their edge really comes from. And so what they say is, look, we've got captive audience who needs capital. We've got enough capital to originate loans and enough of a brand to borrow some money for a short period of time, but we're not a lender. We don't want to hold that risk on our books. So they put in place a relationship with either a bank or a private credit fund or hedge fund that basically buys all those loans as soon as they're originated or shortly thereafter, depending on the relationship that they have with the partner. And so you've got while the money is actually coming from the provider who you click that button with and signed up for that form with, they're actually wiring you the funds, but immediately they're taking that paper that says, hey, Metab's going to pay me, $100 a month for the next year. And they're selling that for, 99 cents on the dollar to someone else to then collect and hopefully get that spread.
Yeah. And, the other thing that Shopify and Amazon and, presumably Flexport are doing is they're kind of leveraging their brand power, right? Because you really trust Shopify giving you money, right? Shopify has this great reputation, but it does backfire when Shopify cuts your loan. They're not doing it. It's the bank who they sold it to is like, oh, I'm not going to give this person any more money. But then who people are pissed at is Shopify, and who this totally killed is Brex.
Oh yeah, they had can I walk through it?
Yeah, please.
Okay, so Brex had an e-commerce specific program. They scaled very aggressively, and they're actually a partner for a few of the communities that I was in, and they just suddenly pulled. I'd say they didn't really pull the program per se, but they definitely ramped it down, and they suddenly reduced everyone's line of credit, regardless of how healthy the business was, basically overnight, which obviously pissed a lot of people off. So now a lot of e-commerce guys are Ramp users like Sean.
Right. And we've seen this massive rise in Ramp, right? Ramp is, worth $16 billion now. And they were always Brex's little brother. But I think Brex up. They totally ruined their brand with a big cohort of people who won't use them anymore. And Ramp has been able to come in there and take the space.
And Ramp's been very consistent with their underwriting. I think consistency with underwriting is quite nice.
I just want to tie it back to the earlier thing. We talked about, maybe some SMS platforms are abusing the power and withholding lists, right? Postscript would never do that, right? But by doing that, I can now never, ever, ever recommend one of these SMS platforms. And if anyone ever uses them, I tell them, get the away from those people and go to Postscript because they're the good guys of this. And it's just
I just send them a link to a thread on e-commerce fuel where it goes through 10 guys saying the same thing. It's even better.
Yeah. And this is where the industry is small and time's really long. So it's you make these decisions now and, I think you end up regretting it. I think Shopify Capital, it still seems to be a good program. People really like it, but they did cut a bunch of people and it's not them cutting it. It's some underwriter and it could actually end up hurting the brand long term.
Yeah, I think it's definitely a good lesson for any platforms to think about, right? The downside of getting this business. It looks so attractive. You're like, oh, I'm going to originate all these loans. I'm going to help my customers out. I'm going to take no risk. But yeah, you're at the mercy of ultimately the credit cycle, right? And whether or not people want to be lending to that segment. And when interest rates are as high as they are and you can get, the return by just parking your money in treasuries, a lot of hedge funds are like, I get enough alpha there. I don't need to go make higher risk loans right now to feel that part of my portfolio.
Yeah, man. So Dan, you've had a long career. You've seen, companies implode and companies explode because of lending, and now you're helping people protect margins. What are the telltale traits of an amazing e-commerce brand that you've seen that work with lending, that work with Fondue, and just if you're in the business and let's say you're putting your own capital into it, what are you looking for?
Yeah. I think what we're looking for, I think about three things. I think the first one is, great product with great story, great margins, all that stuff. This really, when I think of product, I don't just think about the physical, is it quality or not, but I really think about the end to end, is it priced at a good point? Can you manufacture consistently with some redundancy in your supply chain at a healthy margin? Get it when you need to get it. I think of all that sort of in the product bucket, because everything that brings it to life is so important. So I think that's a key thing that we always get excited about when we see a great product come on Postscript or back at Flexport Capital. If we knew that this was going to be a great product, we would get really stoked because we could just see exactly how our money was going to feel that growth. Second thing is the team, right? You can just tell so quickly when we're selling, whether it's Postscript or Fondue, the type of questions that folks are asking, right? Whether they're picking up on no product is perfect, right? There's always trade-offs and pros and cons. And you can tell how savvy an operator is often by how they're buying software, right? are they beating you up over something like inconsequential, or are they actually like focused on what's the upside here and what's the actual risk and digging into that and really aligning with you on that? I think we would get really excited when merchants like just showed a level of business savviness that we could relate to. And we were excited to give them more capital. We're excited to give them better SMS rates at Postscript because we know that they're probably applying that discipline to meta ads and everything else that really fuels the growth of their company. And then I think the third thing is what's really great about e-com is you can, like, I think, learn a lot about I mean, so much of it is marketing, right? It's all digital marketing too, and so we can see how they're showing up and in the story they're tell, and how polished it is, whether it's unique or they're just copying everyone else out there. And I think that being in this industry now long enough, you can just, I'm sure, like you guys, you can see a brand's meta ads and you can be like, oh, they're doing something unique. I want my team to test that immediately. And I think the longer you're in the space, the more interesting marketing someone is doing also gives you a really good insight into how they are growing that company, growing that business, and growing that brand, that we get really excited about. So those are all the big intangibles. And then obviously, like, margins and the financials, if you're getting into the lending side, are the due diligence portion. But we get excited about the team, the product, and the brand story and how it's showing up.
Yeah, dude, lots of fakers in the space. I was going to ask you guys about the best business you've ever seen. So Meetab's out there buying, selling, like scaling, stealing, like however, for all these different brands. So he sees a lot of deals. What's the best business? And then Dan, you did lending. You see Fondue working. What are the best businesses? You don't have to name them, but we'll just talk about, like, hint at them.
I mean, I'm laughing. The story we always like to tell is I was getting into e-commerce, and it was sort of Wild Westy. The one that blew my mind from just like a margins and creativity perspective. This isn't the best business. I'll think about that one while I'm answering this. This was my favorite story, which is a business that was selling bags of dirt that may have had a small chance of having some gold in those bags of dirt.
Dude, people go wild for this concept. I actually know
wild.
There's a promotion we're thinking of running at one company that involves gold. And just because people love the idea of possibly getting like a little bit of gold, it's a real thing. It's like I've seen someone else do that and it just ripped.
And it was, it was as popular with like moms planning a 5-year-old birthday party as, 50, 60-year-old retirees trying to get a little bit of gold by panning and everything in the middle. And obviously, incredibly high margin, unregulated lottery. I wouldn't say that's my favorite. That's the best business, but certainly a good flash of the pan style business that we always get a laugh about. There were some businesses that we worked with at Flexport that had and actually a few of the same names at Postscript, but where I really got to understand their business model was at Flexport because of the side of the business that we worked with. And they were incredibly high growth and incredibly negative cash conversion cycle. Everything was pre-orders. Everything was, so they were collecting all of the money up front for every single shipment, and they were doubling, tripling in size every time they did a pre-order. And so that was just a really fantastic business to watch grow. Because they really, they used our capital as backup, right? They were just like, hey, just rainy day fund. But the operators were so savvy that they realized, look, we can actually own 100% of this business and bootstrap all this growth by really marketing before the product comes in and then having an incredibly tight supply chain to deliver that on a quick basis. So the more you can like flip that script and sell the product before you have it, I think is really interesting. And we had a few, a lot of drinkware, not too much on the apparel side, but a lot of like hard good consumer goods products were doing that.
Dude, the power of pre-orders. I mean, that's a whole episode, but I want to hear your best brand, best tips, best tricks.
I think the best brand we looked at was a kid's product. I can't say what it was, but they had some IP behind the product. Disgustingly profitable, and basically every other part of the business is not optimized, and they just don't pay attention to it. But it throws off a crazy amount of net. I want to say like over 30%, maybe 40%. It grew really cleanly. Owners paid themselves an absolutely insane amount of money. Really cool to see just the power of a great product. And that's when I became more maniacal about PMF and testing product. So I immediately went out and I pinged everyone. I was like, we need to fill our product pipelines right away. Because it is if you've been putting it off for a while, it takes a while to boot it up. It takes a while to get the pipeline full. Like you guys went through that, right, Sean? Were you guys weren't really super, like you guys were primarily focused on the wallet. And then you guys really filled the product pipeline. Now you guys have an absolutely insane amount of releases, like I feel like it's every few weeks, every 2 weeks.
Yeah. I mean, we launch something every week, but like probably like, a big launch every 2 to 4 weeks. And then once a quarter, we're launching like a net new, what we call silhouettes or categories. Like, in Q1, it was power banks, which like we never made before. So we had to make them, we had to sell them. And yeah, you're right. It's not like ads where like, we could get ads set up on any new channel in 2 days, right? Or
especially if you have Connor on the team, he'll do it himself. Yeah,
yeah, dude, the guy's cracked. He's spending his weekend working in. He's like, yeah, I'm moving all my Claude stuff to Cursor, just like some crazy stuff. But you could set up Fondue in, I don't know, a day. You could set up Postscript in 5 days, right? The physical world just takes a long time. If you want to build out a physical product pipeline, yeah, easily it's. The shortest you can get it done is like 8 months. it's just to find a factory, like the rounds of samples, the design work, whatever.
And then so much stuff just doesn't work, right? Like the margin profile ends up being or it's just you can't differentiate enough. So it's just like a product. Now you don't want to launch it. So it's like maybe you have 10 ideas, only 1 or 2 are viable.
Dude, and you can't really test them ahead of time. Like you could do pre-orders, I guess, but like it doesn't really show you like the in-market demand.
You should tell the watches story that you told on the other podcast a long time ago, like maybe 2 years ago.
Yeah, dude. I mean, okay, this is depressing, but
well, that's a cool ending. You found like that's how you found the other categories.
Yeah. So for probably 8 years, Ridge only sold wallets, like literally no other products. It was just wallets, and we barely put out new colors. So like we entered into 2021 and we had maybe 12 wallets on the website. You couldn't buy anything else. And I made this big push. I'm like, we have to get into new product categories. Like we have this big debate. We're fighting about what categories to get into. I'm like, we should do fucking beef jerky. We should do socks. We should just do anything that people can consume. And the team's like, no, it needs to be an accessory. It needs to be something that like our customers are going to appreciate. They like metal things. So like, okay, we split the difference. We're like, we will do watches, and then 4 weeks later, like we had a smaller secondary launch for like men's rings. We go full steam ahead. We make watches, find factories, designs, the whole thing costs like $350,000. We get them here, we release them, and we send the email. We put them live on the website. People, we're debating how many we're going to sell them. Like we'll probably sell all of them in a day, maybe 2 days. Someone's like, it'll probably take a week. Do everything, do the big launch. I'm like, oh, Shopify must be broken because we've sold 0. I'm like, there must be something wrong with our website. None of them. Now people just didn't want them. I've never seen the company more depressed. Literally, people, we were talking about selling all of them and immediately. We're like, no, we can't give any away to like the team. Like we need everyone from all the photo shoots back. There's be such big demand. And like we've just sold all of them. It's taken like 4 years. We finally got rid of all of them. 4 weeks later, we launched rings, super depressed about it, but now rings will do like $30 million a year or something. So it's been an amazing turnaround, but we covered a lot of ground. Meetup, it's your podcast. What else should we talk about? Please tell us what to talk about.
Do you guys want to go back to the macro? I don't think we ever touched on the macro, the store closings with the format data.
I think we got too distracted, man.
Okay, so basically what happened is a popular SaaS company posted about, he posted a chart just showing the format guy. I can't remember his name right now, but
Rashab, yeah.
Yeah, the founder. He posted just a poll from builtwith.com just showing the drop in stores on Shopify. Do you guys remember the specific data? I can't quite remember it. I think he had broken it out among bigger stores and smaller ones, right?
Right. So I'm glad we're breaking this news first because we know marketing operators are going to talk about it. We know operators are going to talk about it. We know e-commerce is going to talk about it, but we have the fastest turnaround time. So this will be out tomorrow. So people are going to be hearing this. It was top 1,000 stores on the entire website, entire internet, top 10,000, and I think top million, and Shopify's share of each of those. And no matter how you chart it, there's just like it's going up and then there's a big downward spike, which means like stores are falling out of the top 1,000, falling out of the top 10,000, falling out of the top million. And he basically posted it like, this is bad. He's like, stores are going out of business, right? Then I'm like, is that true? Like, let's get some other data in here. Then we have Aaron from Ship Hero, he posts, no, he's like, we're seeing package volume go up year over year.
And they do a crazy percentage of all Shopify Plus orders. I can't remember. Even US e-commerce, they're a huge chunk of it.
Yeah, I think there's 6% of all Shopify GMV or something runs through pipes. Like, I'm making that number up, but I think it's like, it's large.
It's big, yeah.
Yeah. Okay, so he's like, no, order volumes are going up. Then the guy from Final Loop comes in and he's like, no. He's like, stores are closing. He's like, what we've seen is, and then today, the Veris guys who they work with No Commerce, they work with Common Thread Collective to like build their like whole data portfolio. They said that US e-commerce was down 9% year over year in June. That's like the data that they're putting out there. So we have some conflicting reports, but the macro is at least directionally that there is more store closures. And usually that seems to be centered around the bottom end of stores because Triple Whale and North Beam both said, no, they're actually seeing good growth and people are joining. But once again, that's probably selection bias, right? Like if you're using North Beam, a $2,500 a month tool, right, to like measure your marketing analytics, you're probably pretty invested in more things going well. So that's the current landscape. Nobody really knows what's going on, but it does seem to be that there is some sort of downward tick in total number of Shopify stores.
We've never seen more high quality businesses in a distressed situation than we have now. The deal flow feels higher and higher quality, and the quality is steadily improved from what we saw in, say, 2021 to now. But again, we do distress stuff. So by quality, I mean like we're seeing nicer businesses that would not have been distressed before, now distressed. And some of that's like tariffs, other things just you have to run much tighter in this kind of economy, et cetera. And they're not used to it, where maybe they were built in 2020, 2021, et cetera, where it was a little bit easier. So,
well, dude, I mean, here, I'll share some stuff publicly. A year ago today, my payroll, which includes benefits, 401k, everybody, was 1.4 million. This month is 900 grand, right? So like in 12 months, I've shiven 30% of payroll, something like that, right? 400 grand off the top. You have to do that. It's like that's the environment we're in right now. And if you think you don't have to do that, think about this. Ridge is a pretty big business. We have like a 90% margin flagship product, and I'm still doing like that. So like that's who you're going to be competing against. And Meetup, kind of explain what you do. Like you're saying there's higher quality deals that are distressed. For us idiots, what does that look like?
Yeah, all I mean is the business actually has a good reason to be distressed, where I think before what we would see is a lot of businesses that maybe just shouldn't exist, right? Like unit economics were kind of broken. They'd received a bunch of VC funding to kind of keep those broken unit economics. Team was really bad. They didn't really know what they were spending against, et cetera. There's kind of shooting in the dark and saying, don't worry about it. We'll make up for it in LTV, which, by the way, never happens. I've never seen a company actually make up for an LTV, except very, very small handful of times. It just doesn't work if you're venture funded. But now we're seeing companies that have historically had really good unit economics, an actual viable business model. They weren't disgustingly funded. They didn't go out and raise like $50 million in VC and then incinerate it. And those are the kinds of companies we're seeing run into trouble, where there maybe is a good reason, right? Like maybe the founder was bought out during PE transition where a private equity group took it over. And now things have just been declining because there's no one to really take true ownership over the business and pivot it. Like you kind of need a strong man when things go sideways, right? Like let's say you saw MetaCAC really jump in 2021. You need a strong man that can pivot the whole company, pivot the product, and maybe they're right, maybe they're wrong, but you need to do something and you do something big. Like one of our businesses, we completely changed it. We pivoted out of being floral focused on like gifting to floral focused on wedding, just because the AOV was way bigger, which sounds insane during COVID, but the math worked out. So, but you need someone who like takes founder level ownership, or basically is a founder that's willing to jump in and kind of strongman the business the way it needs to be run. You really need to run it like a dictator.
Dude, you have to be Frank Slootman. You have to just be ruthless.
Especially in a consumer business where there's a lot of volatility, you have to be willing to react really quickly. Like Sean was saying, right? You can't take your time. The reality is we're not sticky. We're not running some cool enterprise SaaS that's like infrastructure. We're not an ERP, right? Consumers can change their mind. They don't have to buy your shampoo the next time. It's like me. I buy that horse shampoo nowadays. So actually, I learned it was really expensive the other day, so I don't buy that anymore. I just assumed it was cheap because it's for horses. So that and my horse electrolytes.
Yeah, dude. No, it's a lot of great points. Look, a lot of people are struggling, but then it seems like a lot of people are not struggling. So if you're crushing it, and yeah, brother, keep crushing it. And consumer is discretionary. So like, if gas prices go up, our sales will go down. Like Meetab said,
yeah, and sorry, people don't realize what a big chunk gas is of income for income spend for most people. Like, it's a huge chunk of their discretionary income that they have going towards gas. It's kind of crazy.
Let's quiz Dan. Dan, how much do you think it is?
How much do I think gas is of discretionary income? Average American outside of a big city where they're driving a lot, probably 5 to 8%.
Dude, we fucking spot on. Yeah, it's 7%. Yeah, you nailed that. Think about that. Out of all the money they have, $7 out of every 100 goes to filling up their car. It's crazy.
And that's why people go ballistic when gas prices go up, right? Like, it makes sense. I'd be mad too if 7%.
Dude, because
the discretionary, I was going to say, the discretionary point you made is like so spot on, and I've never seen it so viscerally. And we have, we track order volume for our customers because we have to know, do we send a SMS confirmation or not, right? So we see our customers' order volume, and I was shocked to see in the immediate announcement of things like tariffs, how the next couple days would show lower order volume, right? Consumers are definitely paying attention to this stuff, and they're thinking, oh, my gas is going up, my everything's going up, I need to start budgeting. And I was not expecting that quick of a feedback loop. I think overall on the macro, we've seen things kind of like normalize to a trend that is pretty stable now. But I mean, every time there was a tweet, every time there was something unexpected, it would show up in our merchant stores. And so that's when we knew we needed to act and help with what we did for tariff relief. But I think my biggest surprise was, there was a 24-hour feedback loop from macro news to how people were swiping their credit cards.
Oh, yeah.
Yeah. Dude, and I mean, the last thing with gas prices, it's a tax on the poor because...
Oh, totally.
Like, I've never even looked at the price of gas. You know what I mean? And like, I work from home, but if you only make a number of, like, you have a set wage, you have to drive into the city, you have to work your job and come back. Like, gas prices go up, it just takes away money from you. Like, you don't make more money because of that.
Do you guys, one time our payroll provider broke. It was Gusto, and they had a glitch. This is like 4 years ago or something. And I remember it broke, and some of our employees called their managers. They said, I can't make it because I can't fill my car out, because they usually got paid that day and bought gas. It was crazy. I think that's all important to factor in when you're thinking of selling, when you're looking at revenue, looking at sales, and you're kind of factoring in projections. Like, what does disposable income look like for people? Now we have this huge bubble with the student debt coming, right? Aren't those all being enforced relatively soon?
Oh, dude, we'll see what ends up happening. If it hurts the economy at all, Trump's he'll chicken out. I don't think there's a good solution. I mean, dude, okay. Now we're the global economy podcast. The solution is we're going to just inflate away all debt. So it's like, just get ready for 10 years of like, not hyperinflation, but like, 5% per year or whatever. And all debt gets inflated away.
Mm-hmm. Absolutely.
All right, guys, that's an hour of the marketing. Wait, what operators is this?
Look at this. Finance operators.
An hour of the Finance Operators podcast. I'm filling in for the week. I hope I didn't ruin the podcast.
All right. Thank you, Dan, for attending.
Yeah, thank you guys for having me on. It's a pleasure.
Dan, low-key goated, dude.
Cool. Thank you, guys.